You're constantly wading through this sea of information, always looking for those key insights, right? The things that make you feel genuinely well-informed.
Yeah, absolutely.
Well, today we're taking a deep dive into something pretty specific but really fascinating.
Oh, yeah. What's that?
It's how a major financial institution applies, the principles of Islamic law to the world of company shares.
Ah, okay. Interesting. We're talking Sharia compliance in the stock market.
Exactly. We'll be unpacking resolution number 69B from Bank Albilad's Sharia board.
Right, 69B. That's their formal methodology, isn't it? Like their detailed guide for how they analyze and classify shares.
That's the one. And our mission today, really, is to kind of cut through all that detail and pull out the core nuggets of knowledge for you.
Make it accessible.
Yeah. We want to give you a really clear understanding of the principles governing these Sharia-compliant investments, how they distinguish between different company types.
And that whole concept of purification, too, right?
Exactly. How that actually works in practice. Think of it as a shortcut to grasping how Islamic finance is applied right there in the stock market. Get ready for some, surprising precision.
Sounds good. Let's do it.
Okay, so let's unpack the document itself first. We said it's from Bank Albilad's Sharia board. For our listener, maybe we should clarify, what exactly is a Sharia board? And why is it significant that they are issuing this?
That's a really good place to start. So a Sharia board, it's basically a group of highly qualified Islamic scholars, legal experts too.
Okay.
Their whole job is to make sure that everything a financial institution does, its products, services, operations, that it all sticks to Islamic law, fully compliant.
Right.
And what's fascinating about this document, Resolution 69B, is that it isn't just, some general advice. It's a specific, really detailed framework.
So very practical.
Very practical. It underlines this deep commitment to actually embedding Sharia principles right into the day-to-day investment process. It's not just broad guidelines, it's the real nuts and bolts.
Got it. Incredible granularity. And as I understand it, this resolution kicks off by categorizing companies into three main types based on what they do and how they operate.
That's right. 3 distinct buckets.
Let's start with the ideal scenario. What makes a company permissible? The term is Mubah, right?
Mubah, yes. That's the goal for Sharia-compliant investors. Think of it like a pure play.
Pure play.
Yeah, its main business, its core activity is permissible under Islamic law. And critically, it has absolutely no dealings in prohibited stuff. No prohibited investments, no prohibited income. Clean, top to bottom.
Okay, pure and simple. Can you give us some concrete examples? What sort of activities fit that bill?
Sure. The document actually lists quite a few. Things like general industrial companies, agricultural businesses, food production.
Stuff you'd expect.
Right. Also information technology, telecoms, energy companies, and importantly, Islamic banking itself and cooperative insurance, what's often called takaful.
Ah, takaful, that cooperative model.
Exactly. The basic principle here is if Sharia doesn't explicitly forbid it and its operations are clean, then it's considered permissible.
Okay, that seems clear enough. But here's where, for me anyway, it gets really interesting for most people investing today. Mixed companies. Mukhtalita.
Ah, yes, the mixed ones.
This sounds like a much more common scenario, right?
Yeah.
Given how interconnected everything is financially.
Indeed, it is very common. A mixed company basically has a main business activity that is permissible. Good start.
Right.
But it also gets involved in some prohibited dealings. Maybe it holds some interest-bearing deposits or has conventional loans. It's almost, unavoidable in today's global economy unless you're in a fully Islamic system.
Makes sense.
However, and this is crucial, there are very strict quantitative limits, thresholds for these prohibited dealings. If it stays within those limits, it can still be classified as mixed and potentially investable.
Right, the thresholds. This is where the numbers really matter for anyone listening. What are these critical limits? Lay them out for us.
Okay, so the document specifies 3 key limits. Think of them as a line in the sand.
Got it.
Number 1, prohibited investment. Any investment the company has in non-Sharia compliant assets, think conventional bonds, interest-bearing deposits, must not exceed 33% of the company's total assets.
33%. Okay.
Number 2, prohibited debt. Similar idea. Interest-based loans, conventional debt, the kind that operates on riba or interest, which is forbidden, that also shouldn't exceed 33% of the company's total assets.
33% again. Same limit for both.
Yep. And number 3, prohibited income. This one's tighter. Income the company gets from impermissible sources like interest earned must not exceed 5% of the company's total revenues.
Only 5% for income. That seems really precise. Is there any wiggle room or nuance there, especially for companies that actually, make things?
Yes, there is an important clarification. It shows some pragmatism. That 5% prohibited income rule, it doesn't strictly apply to production-based companies if that income doesn't really reflect the core nature of their business.
Ah, okay. So if it's just incidental.
Exactly, like minor interest on a bank account for a big manufacturing firm. The idea is that small, incidental prohibited income shouldn't automatically disqualify an otherwise compliant company that's, focused on producing real goods or services.
That makes practical sense. Okay, and then the final category, prohibited companies, Muharram. What puts a company firmly in this forbidden zone?
Well, there are two main ways. First, if the company's primary activity, its core business itself, is fundamentally forbidden by Sharia.
Like the ones you mentioned earlier.
Exactly. Or second, if it's a company that could have been mixed, but its prohibited dealings, the investments, the debt, or the income go beyond those thresholds we just talked about. The 33%, 33%, and 5% limits.
It crosses the line.
It crosses the line. It's exceeded the tolerance levels.
Can you remind us of some examples, those core activities that are just straight up prohibited?
Sure. The document is very clear on this.
Yeah.
Companies whose main business involves things like alcohol, pork, conventional banks again, the ones based on interest. All right, the interest model is key.
Absolutely. Also, gambling, pornography, conventional insurance, the non-takaful kind, and even, interestingly, dealing in musical instruments is listed here.
Musical instruments. Okay.
Yeah, their whole business model is seen as fundamentally conflicting with Islamic principles.
Right. So, okay, we've got the three broad categories: permissible, mixed, and prohibited. But a deep dive means we need to look kind of inside these companies, right?
Exactly. How does the board actually scrutinize specific things?
Yeah. Like their core business activity, their investments, how they get financing. Let's start with ruling on the activity itself. How do they view that?
Well, the fundamental principle, as we touched on, is that basically everything is considered permissible unless Sharia explicitly forbids it.
Innocent until proven guilty, kind of.
Sort of, yeah. So
Yeah.
permitted activities are wide-ranging: industrial, agricultural, IT, Islamic finance, takaful insurance, and so on. Prohibited activities are those inherently conflicting things: alcohol, conventional banking, gambling, etc. Pretty clear-cut based on the nature of the business.
Okay. And what about investments? When the board looks at a company's balance sheet, how do they distinguish permissible versus prohibited investments?
Right. So permissible investments would include things like shares in other compliant companies, Sharia-compliant investment funds, Islamic bonds, or sukuk.
Okay.
Prohibited investments are the flip side: conventional bonds, deposits that earn interest, shares in companies that fail the compliance tests, like exceeding those 33% thresholds, or investments in conventional non-Sharia compliant funds.
Got it. And income follows a similar logic, I assume?
Pretty much permissible income. That's straightforward. It comes from permissible activities and permissible investments.
Makes sense.
Prohibited income, conversely, comes from any of those prohibited investment channels. The most common example is probably interest earned on conventional bonds or bank deposits.
Right. Okay, what about financing? How a company raises money, how does the board rule on that aspect?
This is crucial too. Permissible financing includes getting funds from Islamic banks, obviously, also issuing Sharia-compliant sukuk.
Those Islamic bonds.
Yep. Or even getting loans from specific entities known to be compliant, like the document mentions Saudi agricultural or industrial development funds. Also, government loans, if they're confirmed to be Sharia compliant, meaning no interest.
Ah, the interest-free aspect is key even for government loans.
Absolutely. And prohibited financing. That explicitly means conventional interest-based loans and issuing conventional bonds. An interesting detail they mention is that if a company holds government loans, it's considered partially permissible only if the loan itself carries no interest. It highlights that fine distinction.
Very nuanced. Okay, insurance is a huge sector. How are insurance companies specifically looked at?
Yeah, insurance gets special attention. For an insurance company to be permissible, it must operate on that Sharia-compliant cooperative model, takaful.
The risk-sharing model.
Exactly, not conventional risk transfer for profit. Plus, they need to have strong Sharia supervisory boards overseeing them, and all their contracts and documents must meet Sharia standards.
So, pretty strict criteria.
very strict. And they note that even non-Saudi companies can pass if they meet these controls and use the cooperative model. If a company fails these tests, if it's a conventional insurer, it's simply prohibited.
Okay. Now, this concept of purification, or tathir, you mentioned it earlier, it feels quite unique to Islamic finance, really highlighting that ethical commitment. What exactly is it? How does it work?
It is quite unique, yes. Tathir, or purification. Basically, if you as an investor own shares in one of those mixed companies.
The ones with some prohibited income under the 5% limit.
Exactly. If you own shares in one of those, Sharia requires you to purify your investment returns.
Wow.
It means you need to calculate the portion of your earnings or potential earnings, really that came from that small slice of prohibited income the company generated. And then you have to donate that specific amount to charity.
Donate it.
Yes, give it away. It's about cleansing your wealth from any impermissible element. And interestingly, this applies whether the company actually made an overall profit or loss, or even if it didn't distribute any dividends that year.
Wow. So it's not tied to your personal profit, but the underlying nature of the company's income.
Precisely. It's about the source of the funds within the company you have ownership in, not just what lands in your pocket.
That's a powerful ethical commitment.
Yeah.
What stands out to you about how they calculate this purification amount? You mentioned percentages before. It sounds very specific.
Oh, the precision is really remarkable here. The resolution lays out a very specific formula for working out the total amount the company needs to purify, which then gets broken down per share.
Okay, how does that work?
Well, first, you identify and add up any explicitly prohibited income the company reported, like clear interest income.
Straightforward enough.
Then second, if there's an unknown or unclear element in the investments of a mixed company, maybe some part of a portfolio isn't fully transparent, they apply a default purification rate. It's 2.5% of the total value of that investment.
2.5%. Okay, standard rate for uncertainty.
Exactly. And third, if the company earns fees or minor interest on its current bank accounts, they add another 0.25%, quarter of a percent, of the current account balance to the total purification amount.
Wow, 0.25%. That's drilling down.
It really is. It shows they're trying to account for even small, potentially problematic income streams. It's quite a rigorous system.
So once you have this total purification figure for the company, how do you apply that to my individual shares? Because obviously, I don't own the whole company, and I might not have held the shares for the whole year.
Right. That's the practical question for the investor. And the resolution provides a clear formula for that, too. You take that total purification amount for the whole company.
The sum of those components we just discussed.
Yes. You divide that total amount by the total number of shares the investor owns. Then you multiply that result by the number of days the investor actually held the shares during the period.
So it's prorated for holding time.
Exactly. And finally, you divide that by 365 days, a full year. This whole calculation ensures your purification obligation is directly proportionate. It reflects your specific shareholding and exactly how long you were exposed to that mixed income.
So it's not just a flat rate. It's tailored to your specific situation.
Very much tailored. It's not a blunt instrument. It's a precise adjustment.
We've just taken a really fascinating deep dive, haven't we, into Bank Albilad's detailed Sharia board resolution. It reveals just how meticulous, how incredibly thorough the process is for making sure investments align with Islamic principles.
It really does.
From classifying companies into those clear categories, permissible, mixed, prohibited, right down to the precise calculations for income purification. It's a testament to the rigorous application of faith in the financial world.
That level of specificity and the unwavering commitment to these ethical principles within a complex financial framework, it is truly remarkable. It really goes far beyond just, simply avoiding a few bad industries.
Absolutely. Which brings us to our final provocative thought for you, our listener, to maybe mull over.
Okay.
How does the kind of precision and the level of detail we've seen embedded within these Sharia-compliant financial guidelines compare to, say, ethical investment frameworks you might encounter in other systems, like ESG or SRI?
Yeah, that's a great question. What does this intense scrutiny reveal?
Exactly. What does this level of scrutiny, this focus on specific financial transactions and income sources, reveal about the underlying values and the core priorities of each different approach to ethical investing? Something to think about.